Good morning, everyone. Thanks for joining us today. We're looking forward to having this chat. It's going to be a little bit of a sort of question and answer with Taylor and I, and certainly the platform is able to take questions from you as well. And just hoping to get some information out there and have a casual conversation about what everyone should know about, or what we feel everyone should know about RSP season.
Yeah.
So if you should know me, hopefully, Peter and Driana, and here at Continuum 2, we've got a great team, but joining me is Taylor Gray, and she's here as our investment specialist. As if you've worked with us, you know that any paperwork or any background work that happens with the investments, you're dealing with Taylor.
Yeah, so we thought this would be something fun and interactive with you guys, right? So it's an opportunity to you guys can learn some stuff. We're going to talk about RSP season today, but it's also an opportunity for you guys to ask questions and get to know us. So hopefully everybody can hear us. If you can't, that'd be great if you could post in the chat. Otherwise, we're just going to carry through. There is a poll that should be showing on your screen. So if you could please answer it, that would be great. There's 3 questions. Do you have a TFSA? Do you use MyCRA? And where do you go to check your contribution? So I'll just give a few more seconds for that poll, and then I'm going to end it, and we're going to proceed because I know your time is valuable and some people are on their lunch break.
Yeah, and that's one thing definitely with this. As you can see, we kind of scheduled it for 20 minutes. We really wanted it to be quick and not, an hour-long session that just bores everyone to death. So we'll jump right into it.
Just going to share the results of the poll.
So what we're going to cover today, the poll, basically share that information, RSP season, but what does that actually mean? You hear a lot about it in the media, and we've got all kinds of focus on RSP season, especially during January and February, but why should it matter? Why does it matter to you? Then we're going to talk about the RSP and versus TFSA, a question we get quite often, and then red flags that we see, and ultimately how to make an RSP contribution or TFSA contribution.
So I'll go through the poll results here. Do you have a TFSA? We have 50-50. Some say yes and some say no. That's great. We can educate you a little bit more regarding the TFSA and perhaps the reason why it might be suitable for you. Do you use MyCRA? Some people don't know what it is, and then we have people saying no. So we will definitely tell you what it is. And where do you go to check your contribution? Phone as well as notice of assessment. So we're going to proceed.
Awesome. So when we're looking at, it's RSP season. So let me just close one of these windows. It's funny. Is it time to contribute? So you can see here we've got, all of 2019, March to December, January and February. And we did that on purpose because it is very confusing. Basically, what it comes down to is you've really got to structure it to work with your either accountant or if you're doing your own taxes, that you can use all of 2019 for your 2019 contribution. So what I mean by that is from January to December, you can use all 12 months. But you could also use January and February of 2020 for your 2019 contributions. So now you're into 14 months. So that's where things can get confusing, because if you did that, you could be in danger of over-contributing. So when you look at scheduling it, you can see, March to December 2019, the third bullet down, is typically what people are doing. Is you have March to December of last year, and then you have the first 2 months of this year, and that becomes your 12 months that you're using your RSP contributions. But really, it's up to you to decide which slips you're using for that tax return and making sure that you're staying on top of it.
Now there is a deadline to contribute to your RSPs. For the first 60 days. So the deadline it's March 2nd, 2020, so this year. But you should really have your contributions in by February 28th. So February 28th is the Friday, March 2nd is the Monday, and we just don't want you guys to miss the RSP contribution deadline. So make sure you have them in by then. And also be sure that if you are providing a form, make sure that it's signed and dated by you. If you're providing a check, it's very important that you ensure that the check is signed, as well as that the date of the check is actually in 2020. Some people get a little carried away, I guess, and they put 2019, they put the year previous, and that can lead to some issues, and we might not meet the deadline that way.
And this is something, Taylor and the entire team here, we certainly try to stay on top of for all of our clients. It is challenging when, you got busy work schedules and business lives and home lives. So it certainly is one of those things that can easily sort of slip through the cracks. And, put a calendar reminder if you can. And that's what we try to do is, like I said, stay on top of it. But those deadlines for sure, you don't want to miss, because if you're hoping or planning to have a good tax return based on a good RSP contribution, you don't want to miss doing that lump sum. This. Okay, so overview of the notice of assessments. Now, this is one of the first things that we're always asking for of all of our clients. If you're working with other financial institutions, they're probably not going to be asking you for your NOA or notice of assessments, which really at the end of the day means it's up to you to be staying on top of this. So I wanted to put this up here because a lot of people, they maybe don't know what the notice of assessment is or why they're receiving it. After you complete your tax return, you do receive the notice of assessments. If you're signed up for online, so that's the mycra.ca, they actually stop mailing it to you, and you have to go online and you have to actually pull up this information. And unfortunately, the online format isn't as nice and clean as the one they mail you, but the same information is there. So I just want to do a quick walkthrough of what the NOA is and sort of why it's important. So it gives you your deduction limit for the previous year, 2018. You can see this one was 20,000. Employers are PRPP, so that's your pension plan contributions, and basically what that amount was. 18%, so sometimes people hear 18%, but they don't really know what it means. Basically, CRA looks at 18% of your taxable income in the previous year, and that's what they use towards your RSP contribution room in the following year, but they have a max. So for here, you can see it's 26,500 is the maximum, and in this scenario, the maximum was hit. Now, the pension adjustment. We have red flags coming up later on in the webinar, and we're going to talk about one of the big red flags is not being on top of what the pension adjustment is, or that you even have one, because that actually eats into your RSP room. And quickly, a pension adjustment comes from contributions that employer is making towards a pension. So if you have OMERS or HOOP or one of the large pension companies, you're going to get a pension adjustment on your tax return and on your notice of assessments, and that definitely eats into your RSP room. So here you can see there was a pension adjustment reversal. So then their limit for 2019. And finally, available contribution room for 2019 after looking at everything in this instance was 20,660. And that's really the number that this person should be looking at if they want to max out their RSP room and not go over.
Okay, so the TFSA. I know there was some people that said they don't have one. The TFSA is really great. We're going to talk about the reasons why further on in the webinar. But for now, I'll just let you know that there is a contribution limit for TFSAs. And if you have never contributed and you are at least 18 years old in 2009, there's a little chart here showing each year how much you were able to contribute to your TFSA. And in total for this year, it'd be 69,500 that you could contribute to your TFSA. But really what you want to do is just call CRA or go online at myCRA, for example, and Peter, I guess we'll talk about that later, to just be sure about your contribution room. And also what you should know is that if in this year, for example, you were to pull out some funds from your TFSA, it's important that you wait until the next year to actually put the money back in if you want to avoid over contributing to your TFSA, because that contribution limit, it doesn't get updated on a regular basis, but on an annual basis.
Definitely staying on top of that is really important, and we'll chat more about that further on. So we can see here difference between RSP and TFSA, and this is definitely a question that I receive a lot when sort of out on the road and chatting with people. So I wanted to take a quick opportunity just to really chat on that. And you can see we kind of built like a chart here. So on the RSP side, you can see, really designed for retirement savings. The caveat to that, of course, is the first-time home buyers plan. So if you haven't purchased your first home yet, you can basically borrow the money from your RSP. Outside of that, really it's for retirement savings. Tax sheltered growth, of course, is a great advantage of the RSPs, but that's also what the TFSA has, is tax sheltered growth. So contribution reduced taxable income. Now this is the important one and the big distinction between RSP and TFSA. And although TFSA has been around for a number of years now, still get a lot of questions about how is it different or why does it matter? And that's really the big differentiating factor between the RSP and the TFSA, is that when I make a $10,000 contribution to my RSP, that reduces my taxable income by $10,000. So you get a pretty big impact when you're doing your tax return and you get that tax relief. On the TFSA, on the other side, you're actually taking out after-tax income and putting that into your TFSA, and there's no advantage on your tax return for doing that. The growth on both of the RSP and TFSA happens tax sheltered, but on the TFSA, there's no tax relief for making deposits. Now, if we look at withdrawals on our RSPs, if I take $10,000 out of my RSP, then that becomes $10,000 of taxable income. So while working, there's people that certainly look at their RSP and they see this pot of money and think, oh, wow, I could really use that money, whether it's a new roof on the house or a new transmission in the car. And they say, well, I'm just going to pull it out of my RSP. Well, someone that's making $80,000, if they take $10,000 out of their RSP, then for tax purposes, they just made $90,000. And in some instances, it can put you in a higher tax bracket. So we really try to encourage people to avoid at all costs to make RSP withdrawals while working. And that's where there can be a lot of confusion about RSPs, because people say, oh, they don't make sense, they don't work, because you got to pay taxes when you take money out. But when you're taking money out in retirement, and especially at over the age of 65, you can split that withdrawal income. Really what's happening is you're in a much lower tax bracket during retirement. There's very few people that would still be in the highest marginal tax bracket based on RSP withdrawals or based on retirement income alone. The TFSA, on the other hand, you put $10,000 in, you get no tax relief for doing that. It grows tax sheltered. When you go to pull the money out, there's no tax implication for pulling the money out. So it definitely is a great, as you can see on the top, flexible account that you can put money in, you can take it out, just being cautious about timing, and Taylor will talk about that further on in the webinar. But really, those are the two big differences between the RSP and TFSA. So when you look at the goals and why we're saving, that's typically where we would start, as well as income. Anything you'd like to add on that, Taylor?
I don't know. What's the next slide? All right, the TFSA. So the TFSA can be used for retirement savings, but it could also be used for emergency fund or even as a travel fund. Like, what fun is that? Eh? You'd be able to save for your vacation, I guess. So where can you go to find this information? So My CRA is somewhere that you can go. If you just type into Google CRA, it'll bring you to the government website, and you can sign up there if you'd like to, if you don't already have an account. It does take up to 2 weeks to actually get signed up, because they need to mail you a document that you can, it has a password, I guess. And so you can enter that password in online, just so it's very secure. But once it is set up, it's actually really handy just to hop online and ensure that you are within your contribution limits. So a question we get is, should I top up my TFSA this time each year? And we say, yeah. So our clients, those that have a non-registered account, we actually will typically pull from the non-registered account and contribute towards the TFSA in that way. Right. And then I guess in another way that we would do it is with RSP room, right, Peter?
That's
you
right.
want to talk about that?
Absolutely. So when we're looking at, making contributions, again, a lot of times we're going to get asked, should I be making contributions to my RSP? Should I be doing it towards a TFSA? What's the right thing for me? So, and this is where we can see the low income versus high income that was on the previous slide. What we're trying to highlight here is that, if we take a low income of $20,000, obviously that's a little extreme, but what it's going to do is basically highlight the point of what we're trying to really bring to people's attention, is that looking at your income when making RSP contributions is very important, and it also helps dictate the amount of contributions. So in this instance, we have someone who's earning $20,000 income. They're only going to owe $1,600 total tax, with an average tax rate of 8.27%. So very low tax rate, marginal tax rate of 25%. So what that means, and why this is important, is someone that makes $1,000 RSP contribution that is making $20,000, basically they're going to get back $250. If we contrast that with someone making $120,000, the taxes they're owing is $32,000. The marginal tax rate that they're at is 43%. So at 43%, they put $1,000 in, they're going to get 430. So basically twice as much back. So what we're trying to highlight here is that if someone that has low income, probably better off to wait until their income goes up, because the nice thing with RSP room is it keeps getting accumulated, so it grows year after year. And if your income is projected to go up in the next 2, 3, 4, 5 years, you may want to time that. You may want to look at, what your income is going to be in the future and wait until you get sort of more bang for the buck, if you will. But if we look at, in this instance, someone that's going to get a marginal tax rate of 25%, they may be better off just making TFSA contributions, letting it grow tax sheltered, because when they're drawing that money out, they can also pull it out tax free. Versus the person making 120, likely going to be much better off starting right from the get-go with your RSP contributions, and they're going to get a 43% tax advantage for doing that. I'll go to the next slide.
All right, so we're going to talk about red flags.
Yeah, so we're going to move into red flags. So basically, when we're looking at, what are the things that jump out at us that people should be aware of? So when we look at contributions previously reported, there's going to be a slide that specifically talks about that. This is definitely a big red flag. And the Ernst & Young website that I just showed you, and we'll share the links further on that you can see, really kind of highlights why it's important to stay on top of that.
Right. So I guess we'll talk about the employer and group RSP now, right?
That's right.
So if you have a group RSP account, you can be contributing to your RSP, as well as your employer may be contributing to your RSP. And you just need to be aware that just because it's not coming from your pocket doesn't mean that it's not impacting your contribution. Your employer's contributions to your RSP do impact your contribution limit, right? So I hope that's clear. I don't know if I need to explain that a little bit more, but in the next point regarding first home time buyers, if the money is coming from your pocket, you can use that towards your first time home buyers. However, if the money is not coming from your pocket, you really, I guess you don't want to be using that because you'll be taxed later on for it, right? So there's not really much benefit.
That's exactly it. So what we're seeing is that, when people are signed up for a group matching program, what's happening is you're making those contributions with pre-tax dollars. So your employer takes it right off your payroll. You never pay tax on that money. And if you go use that for a first-time home buyer's plan, what ends up happening is you never pay tax, so now you're going to owe the tax on that amount. So exactly like Taylor described, really what you want to make sure you're doing is using your out-of-pocket money that you've already paid tax on, your after-tax money, and make your contributions with that. So just something to be aware of, and make sure that you're thinking about, where these contributions came from and if you can use it for a first-time home buyer's plan or not. So when we look at RSP red flags, this is definitely a big one. Highlighted, are kind of what we like to point out as the main parts that you want to watch for. But most importantly on this slide is this unused contributions previously reported. And we've seen this come on many, many tax returns that we end up reviewing for our clients, even ones that accountants have done for our clients. And no one really flagged the issue or the question of, well, what is this and why is it important? This is basically contributions that have already been made, but you didn't use it for your tax return in the previous year. So basically it's 10,000 in this example, 300 of room that has already been accounted for, has already been used. You already have the tax slips for it. So when you get your notice of assessments, it's already basically been eaten up. And now this person, you can see, is a negative number. They're over contributed. So definitely something to be aware of. You see a negative number here, or you see unused contributions previously reported, you definitely want to start taking notice and make some changes in terms of what you're going to do going forward.
Okay, so there's some information there about contributing to your RSP, and now you're ready to contribute. So if you're with a company plan, you can contribute by form of paper, right? So there'll be a form, you can sign it, indicate how much you would like to contribute, and provide a check. Now, if your company has provided a bonus to you, which is nice, you can go to your payroll department, I think would be best, right, Peter?
Yep.
And then they can actually help you to allocate that bonus towards your RSP contribution, which is neat. Another method is to simply go to your bank. You can maybe even do this online, just take a withdrawal from the account if you've already set up the banking. And then another method would be to pay it like a bill, like you would your Visa or your MasterCard, for example, and to send the funds that way.
Exactly.
Personal plan, I'll cover that one too. Okay.
Please do.
All right, so this one's my favorite because I do it quite often here. So contributing to your personal plan, it's quite easy. Again, by paper, you could have a form and a check. But in some cases, if you were to contact me, you might be able to just send along a check. And then another method would be by bank, so just withdrawing from your bank account. So definitely contact me if you're a client here at Continuing To, and I can tell you the best way to do that.
Great. So for more information, of course, you can always contact us. We're always happy to help. And we've got this, we'll again include the link. I'll show you here. Why we included this link. And then the tax calculators are the ones that we are showing previously. And we like this link. It's basically from Ontario Securities Commission, but it talks about being aware of the deadlines and some general information, what unused RSP contributions are. So a good summary of what we talked about today. And then the Ernst & Young website, fantastic. I definitely highly recommend this. So there's two links that I always share with clients. One is the 2019 RSP savings calculator, where you can put in your income, so you can put in anything you want here, and then you can put in what your contribution is. So this person is going to do 10,000, and you put calculate, and it's going to tell you in Ontario you're going to get back $4,341. The other one that I like is it's the personal tax calculator, and what I really like about this one is it shows you the total tax payable. It shows you what the after-tax income is, average tax rate, so what's the average tax rate on every dollar that was paid, and then also the marginal tax rate. And this is the marginal tax rate is the one that we're always looking for when we're looking at making RSP contributions. So just some really good resources that we find are helpful for people.
Yeah, so I guess that's most of the information. I just want to make it clear that for RSP contributions, if you are a client with us, do not hesitate to contact myself. Again, my name's Taylor, or Lori in the office. So Lori will handle the group side, and then I handle the personal side. We will help you with your RSP contributions. If you aren't a client with us, then you can just go to your banking institution, for example, and contribute that way. So I just want to make that clear, since there is a deadline coming up. Contact us if you have any questions.
Absolutely. And our sort of parting wisdom is monthly. As you can see on the screen, we always are trying to set everyone up monthly just for consistency and budgeting, and it just becomes a regular habit. You don't even know that it's gone. And it also takes advantage of basically every time it's called dollar cost averaging, every time you're putting that monthly contribution in, as the markets go down and up, if it's down, what happens is you get more units, and you actually all the stats show us you actually get a better rate of return by contributing consistently every month. Notice of assessment, always be on top of your notice of assessment. We've certainly seen a number of people in an over contribution state, and notice of assessments is the first place that you should be looking at. And then always take the company match. This is something that's always a little bit bewildering. The company has built a plan that's giving this matching. So whether it's 3% and 3% or 5 and 5 or even 1 and 1, any dollars that the company is going to add on top of it, I call it a free rate of return. And if it's 100% match, I would say, well, who else is going to give you a 100% rate of return on your money? So certainly something that should always be taken advantage of. So with that, I want to thank you very much for joining us. We appreciate you taking the time out of your busy day. And
yeah, this was fun. I hope you guys enjoyed it, and maybe we should do some more on different topics. I guess if you guys have any questions, feel free to ask away in the question and answer section, or even in the chat, or you guys just know where to contact us.
Absolutely.
Yeah.
And thanks for joining us. And yeah, hopefully this is our first and not the last.